Hi, welcome back. It's been a while, but I really didn't have anything interesting or original to say anyway. But finally, I think it's time for me to talk about something we all seem to be talking about, which is AI and ChatGPT and how it's going to change our lives and how it's going to affect our investments. Now, I'd like to start this session with a few confessions. The first is a boastful one, which is my portfolio has held its own this year, but it's because of two stocks that are in it. One is NVIDIA and the other is Microsoft. And as if you've been following markets, know those two stocks have been borne up, have benefited from the AI story. The second is, I'd be lying if I told you that I bought these stocks to benefit from the AI story. I bought Microsoft in 2014 and NVIDIA in 2018, and AI wasn't even a thought in my mind when I bought these companies, which I think reinforces what I've always believed. It's better to be at the right place at the right time, to be lucky, than it is to be smart or good. And I just got lucky. However, the rise, especially in NVIDIA's stock price, has led me to reassess its value to make a judgment on, hey, does it still belong in my portfolio? Now, since it's confession time, I'd like to add a couple more confessions before I get started. The next confession I'd like to make is the semiconductor business is still a bit of a mystery to me. There are people who've forgotten more about the semiconductor business in the last week than I know about it. So my knowledge is skin deep. If my knowledge of the semiconductor business is skin deep, my knowledge of the AI business is even more shallow. I'm at the ChatGPT level of AI knowledge. So with those confessions in place, let me get started. Since I knew very little about the semiconductor business other than what I saw of it from the outside as an investor, I decided it behooved me to take a look at how this business has developed over time. So let's go back in time. If you look at the semiconductor business as it exists today, it had its birth in the 1980s with the growth of the PC business. In this graph, I look at the growth of semiconductors as a business by looking at the revenues for all semiconductor companies starting in 1987 going through 2023. You can see the growth in billions of dollars going from less than 50 billion to close to 550 billion over the course of 36 years of history. You can also see that the bulk of the growth in terms of annual growth rate happened in the 80s and the 90s. So 15.6% growth in the 80s, and that probably is understated because if you go all the way back to 82 or 83 to the very beginning of this business, that growth rate could very well be 50 or 60%. Then you get the 1990s, the dot-com boost led to more growth, 14.87%. For the bulk of this century though, this has been a maturing business. So the lesson I take away from this graph is this is a growth business that is matured. In fact, in the 20 years, from 2001 through 2020, the growth rate is between close to 4%. It's true you had a surge in growth in the last couple of years, but that's more a blip than a trend. This is a growth business that is maturing, if not already mature. Now, that's the bad news, it's maturing. The good news is this has always been a profitable business. In this graph, I look at different measures of profitability, starting with gross margin, operating margin, net margin. And for those of you familiar with my writings on margins, each captures a different component of the business model. The gross margin essentially captures how much it costs to produce the product. It gives you a sense of unit economics. The operating margin gives you a measure of how much is left over after other operating expenses. And net margin is what you get after taxes and after interest expenses. With semiconductor companies and technology in particular, technology companies in general, though, we know the accounting is screwed up. In what sense? The biggest capital expenditure at a technology company is R&D, and accountants have treated R&D as an operating expense. It's a horrendous mistake in my view, and I think that it skews the profitability of technology companies. So over time, I've learned to capitalize R&D. What does that mean? I essentially treat R&D as a capital expense and amortize it over time. And it effectively changes your picture of the company in two ways. One, it restates profitability, and you can see that with the margins adjusted for R&D. And I capitalize R&D at semiconductor companies with a 5-year life, essentially arguing that it takes about 5 years between the time you do R&D and a commercial product emerges. And I amortize it straight line over 5 years. The bottom line is, across time, this has been a profitable business, especially after you eliminate the first decade, which was the growth decade. You can see margins have settled in. Operating margins around 20%. And if you adjust for R&D, it gets a little higher. And your net margins are lower simply because you've got interest expenses and taxes. Yeah. So if you look at the most recent 2 years, the operating margin prior to adjusting for R&D is about 22%, and the R&D adjusted value is about 25.5%. So this is a growth business that is maturing, but it's also a profitable business. One more thing that should jump out at you as you look at these graphs of margins is the margins are not stable over time. This isn't a Kraft Heinz or a Coca-Cola where margins stay pretty stable over time. The semiconductor business is a cyclical business. You can see the cycles and the dips you see in margins and the recoveries again. So it's a profitable business with clear cycles driving profitability. And markets over time have had a love-hate relationship with semiconductor companies, at least in the aggregate. In the 90s, they loved semiconductor companies. You can see the market cap zooming during the dot-com era. Peaked at about 2000, and then you see the collapse over the next decade. Between 2000 and 2010, you can see the collective loss in market cap. The last decade was actually a very average decade in terms of market cap, notwithstanding the success of companies like NVIDIA. And then again, you see the rise in 2020 and 2021 in market cap before the 2022 correction. So over time, there have been good periods where markets have loved semiconductor companies and periods where market cap has either stagnated or decreased over long periods. So revenue growth has slowed down. It's a profitable business with cycles, and the market has a love-hate relationship. Finally, if you look at who the winners have been in this business, it's a shifting cast. In this table, I look at the top 10 semiconductor companies in each decade, 1990, 2000, 2010, 2020, and 2022. As you see, the middle 3 decades, Intel took the top spot. Then 2022, Taiwan Semiconductors rose to the top. And if there are any patterns here, it's that the Japanese chip makers who used to dominate the 90s seem to have dropped out and have been replaced with South Korean and Taiwanese manufacturers. Interestingly, NVIDIA made the top 10 list in 2020. So it's relatively recent that it made the top 10 list. And it stayed in the top 10 list in 2022, but it's not at the very top of the list. I don't think it aspires to be at the top of the list. As we'll see as you look at the NVIDIA model, why revenues have not been the focus of this company. Now, as the makers of chips have changed, so have the users of chips. In the 1980s and through the 1990s, the biggest user for computer chips was, of course, personal computers and computer-related products. In the last decade, smartphones have increasingly become among the largest consumers of chips. And you can see that in the difference even between 2015 and 2022. And if you looked at 2010, you'd see the trend line even more. Smartphones are increasing the chips, but the growth in the smartphone business might be behind us. In fact, in the third and final pie chart, you notice the projection for 2030, and you can see smartphones have wireless communications. Where the smartphones fall, are going back to becoming a smaller part of the pie. So who's going to grow? At least based on what you're seeing between 2015 and 2022 and what people are projecting in the future, it looks like automotive companies are increasingly going to be consumers. Why? For chips into new cars and for automated driving for when it's coming. And data storage is becoming a part, and data storage is where the AI business is going to be. So you can see that the user base for computers is for semiconductor chips is changing, and that may change the characteristics of the business in terms of the volatility. The more diversified your user base, the more likely it is that you're going to see volatility decrease, because when one user drops off, another one steps in. So that's the background on the semiconductor business. Maturing business with profitability, with cycles, and a changing cast of who's leading the business and who's using the chips. Now let's talk a little bit about AI before we look at AI's opportunities here. Or let's talk a little bit about NVIDIA before we talk about AI. I started by looking at NVIDIA's history. And if you look at NVIDIA's history, it's a company that was founded in the 1990s, went public at the end of 99, but was really a speck on the horizon when you start the century. And clearly, it's built up over time. The bulk of the build-up in revenues, though, happened in the last decade. And it came from NVIDIA being in the right place at the right time in two businesses that essentially became niche and profitable businesses for semiconductor chips. One was gaming and the other was crypto. And NVIDIA was right in the forefront of both those businesses. And you can see that in terms of the growth, especially between 2016 and 2020. Note that the entire semiconductor business's revenues leveled off in the last 20 years at about 4%. NVIDIA fought that trend and succeeded. And it wasn't an accident. The fact that it was in the gaming business first, you could say that was lucky. The fact that it was in the crypto business, you can say that's very lucky. And the fact that it's in the AI and the automotive business, you got to assume that this is not luck. This is part of strategy. Now, the way I would describe NVIDIA, it's an opportunistic company. It's found a way to get ahead of the crowd for niche businesses are growing, and it's managed to deliver revenue growth. Even more impressively, it's delivered this revenue growth with sustained margins. If you take a look at the operating margins between 2021 and 2023, the operating margin before adjusted for R&D was about 25%. That's about 4% higher than the entire semiconductor business. And once you adjust for R&D, the difference becomes wider. The R&D adjusted margin for NVIDIA is closer to 38%. And in fact, in 2021, that margin was higher than 40%. This is a company that's been able to grow in a business that's maturing and be more profitable than the rest of its peer group. Now, as I said, this did not happen by accident. NVIDIA has been investing in immense amounts back into the business. Much of it is in R&D, but it also takes the form of small acquisitions, technology, platforms, manufacturing capacity. And the way you can see how much they're investing is by looking at a couple of ratios. One is you can actually look at the total invested capital, and the total invested capital is the red column, and you can see how it's soared over the last decade. This is a company that's been investing large amounts to get to the place that it is. In fact, one measure of investment efficiency is to look at how many dollars of revenues you get per dollar of invested capital. And in that measure, NVIDIA actually looks like it's not that efficient. It's delivering only 62 cents. Just to give you a sense of perspective, that number across all semiconductor companies is closer to 1.15. So the company's been an investment machine. By itself, that's bad news, right? That's negative cash flows, but it's been a productive investment machine. If you remember, I called it the opportunistic growth company. One reason it's been able to get ahead of the crowd in those growth businesses, the niche businesses, it's because it's invested to be ready for that business. So it's grown, it's been profitable, it's invested a lot, but it's invested productively, and the market has loved it. This is a company that's had a mega market payoff. Of course, the headlines you saw a few weeks ago when it hit the $1 trillion market cap is testimonial. But this is a company whose market cap has gone from basically nothing to over $1 trillion over the last decade. And as you look at the market cap year by year, there's something I think that we need to remember. Even the biggest winners don't get there without any pitfalls. If you take a look at NVIDIA, it is true it's been a great decade for market cap. And if you look at its entire life, this is a company that's clearly a success, but it's had drawbacks. In fact, it's had at least two near-death experiences. One in 2002 and the other in 2009, where the market cap for the company dropped by more than 80%. You're saying that was a long time ago? Even in the last decade, take a look at 2018 and 2022, where the company lost, big chunks of market cap. Now, I told you I bought NVIDIA in 2018. I bought it in that downturn because I valued it then, and I decided that it looked like a good value. I had no idea AI was coming, But you can see that even the very best companies have periods of the market down on them. The reason I say that is often when you point to big winners and people who don't hold the stock look back, they say, I could never have bought that stock. If it's that highly valued, probably always overvalued. That's almost never the case. Even the biggest successes have had periods in their life when they were undervalued. You just have, I got lucky and found one of those periods, but I'm sure there are dozens of companies where I've missed those undervaluation phases. So that's the NVIDIA part of the background that I wanted to put in place. So we've talked about semiconductors. We've talked about NVIDIA. Let's talk about AI. I'm old, and my kids point this out to me. But one of the benefits of being old is you've seen decades of change. And in the last 40 years, we've seen a lot of change. In fact, we've seen some revolutionary changes. Revolutionary changes change the way we live and work. And in the case of, in my case, I started in the 1980s. PCs changed the way we work and live. In the 1990s, it was the dot-com boom, and much as you look back and say that was a bubble, it changed the way we live. Then you get to this century, and smartphones clearly have changed the way we work and live. And in the last decade, social media, for better or worse, has changed the way we live. So the question with AI is it revolutionary change or is it incremental change? Incremental change is change that matters, but not change of a magnitude that everything changes. Now, for every revolutionary change, there are 3 that are posited as revolutionary changes but don't quite make it. For instance, just in the last few years, we would talk about the cloud, right? The cloud business. I think it's a great business. But it's not revolutionary. It's not going to change the way we live because individually, most of us don't relate to the cloud. I mean, we use businesses that use the cloud. We know when the cloud is down because our businesses don't work. But I don't think it has the effect on our personal lives that the revolutionary changes do. The metaverse. Maybe if you're below a certain age, you're very excited about virtual reality, and the metaverse sounds like something you want to be in. For a lot of people, though, it sounds a little geeky, to be quite honest. So I wasn't as excited about the metaverse when Facebook talked about it because I wasn't sure. It was incremental change. Don't get me wrong. There is a lot of money to be made. And finally, you take things like Web3. My reaction is, you must be kidding me. I don't even know what that means. How can it be a revolutionary change? So the question is, where would AI fall? And I'll be quite honest, a year ago, I'd have said, look, it's like the metaverse. I mean, who cares about AI? It's not like everybody's life is going to be affected. But it's interesting how points of view change because of small news stories. And to me, ChatGPT was what broke the AI story into everybody's, I must read about that column. I mean, ChatGPT by itself is not revolutionary AI. It's actually very primitive AI. But the reason we could all relate to it is because you could see what ChatGPT did. Now, I'll tell you from a personal standpoint, I see AI all around. People talk to me about AI. I think it has the potential to be a revolutionary change. And that means that it's going to affect a lot of companies, a lot of lives, a lot of work. And I'm not quite sure where it'll lead us, but let me use the experience from past revolutionary changes to get a sense at least of what AI will do if it's a revolutionary change and it's here with us for the next decade, what it might do. Let's start by looking at, is this a net plus or a net minus for stocks overall? So if you look back at the PC business and the dot-com business, they were net pluses, right? In spite of the back and forth of markets, they pushed up markets in the 1980s and 90s. Before you decide that that's the rule, remember the next decade, 2000 through 2010, was one of the worst decades in stock market history, right? Where stocks essentially were flat for a decade. And then we rebounded back. So I know 4 decades is not a long time period in stock market history, but if you look at the 4 decades of revolutionary change, the average return for stocks, the average annual return is about 10.95%. The average annual return in the 50 years leading into it is 9.17%. I'm not going to draw any strong conclusions, but it looks like a net plus, but not a huge net plus. This is not going to make a revolutionary change in your portfolio, but it's been in general revolutionary change seems to be a net plus for stocks. But there is a dark side. And we often don't talk about the dark side, which is as you get revolutionary change and new businesses come in built around the revolutionary change, there will be old businesses that get disrupted. We talk a lot about the disruptors, but we don't talk a lot about the disrupted. But those disrupted are around us, right? So the online revolution gave birth to Amazon, but it destroyed the brick and mortar retail business. Right? So when you look at these disrupted, there are a couple of things we've learned from history, which is there will be investors in those disrupted companies who will lose money when those companies get disrupted. That's stating the obvious. But worse still, they will invest even more money in these disrupted companies because they will look cheap to them. This is a classic value trap, right? So if AI succeeds in its promise, the overall market might end up being a little higher, but there will be businesses that get upended and disrupted. We can start making a list already of what those businesses will be. And right now we're in the hype phase where the claim is everything will get disrupted. Yesterday I read an article that claimed Excel is dead because we have AI. I don't think so. But at this stage of hype, who really knows who the targets will be? But I'm more interested in the value effects because when I hear about people using AI to justify a premium for a company, they're talking about an increase in value that comes from AI. And to understand how AI affects value, I would recommend or suggest that you break down AI-related value effects into the type of business that you're talking about. I mean, let's face it, AI is going to bring in demand for hardware and infrastructure that is AI specific. The NVIDIA story is clearly an AI hardware story where its market is AI optimized computer chips, and NVIDIA is expected to grab a large market share of those chips. This is perhaps the most tangible part of the story, the part of the story where it'll be easiest to put numbers on, but hardware and infrastructure for AI. You have AI software businesses where essentially that hardware is useless unless you can come up with the software that allows you to take advantage of the computing power. And it can take multiple forms, AI platforms, chatbots. I mean, right now we don't even know what the extent of this is, but there will be companies that make their money from writing software. After all, much of Microsoft's increase in values come from the perception, at least, and less tangible with Microsoft than with NVIDIA, that they'll be able to take advantage of that AI software business. AI software by its very nature, though, and the hardware is built to take data and actually convert it into actionable policy strategies. In fact, I know big data was supposed to be revolutionary and it never quite made it. Big data twinned with AI might actually pull it off. So my guess is there'll be businesses that actually collect data precisely because AI will use it or process data in a different way. So your company can be an AI data company. And finally, you have companies which will try to apply AI to make money and already get at least a dozen ads for companies that say, we can do your consulting, your appraisal, your investing using AI. Now, I'd caution you though, because the biggest pluses of AI, at least as presented by its promoters, it'll allow companies to reduce costs by replacing manual labor with AI-driven applications and make them more efficient. And the extension of that is that it'll make companies more valuable because it'll make them more profitable. I don't think so. I was saying, and I know people get tired of hearing me say this, if everybody has it, nobody has it. And my guess is AI will collectively make companies less profitable, companies who use it, rather than more, because everybody will invest in AI. And if it does reduce costs, they'll compete on price, bringing down margins. So essentially, it'll be like mutually assured destruction, where the only beneficiaries are the purveyors of AI products, not the users of those products. Now, of course, there is the question of what AI will do for society, and after seeing the changes that revolutionary changes brought to society over the last 4 decades, I'm a little bit cynical because right now you're getting people tell you about all the wonderful good stuff that's going to come from AI. But we're also, and unlike the previous revolutionary changes, hearing from people who are cautioning us about the dark side of AI, how AI can be used as an instrument by big companies to control minds, to acquire power. So I think we can draw some lessons from past changes. One is that AI will have a good side and it'll have a dark side. And I know some of you hope that the dark side will be kept in check by regulators and laws, but I'm not that hopeful. I mean, have you seen senators ask questions about AI? I have, and it's clear that they have absolutely no idea what they're talking about. I'd be terrified to see the legislation that comes out based on their understanding of AI. And we also know that any regulations or laws that you might write to restrict the dark side of AI will have its own unintended consequences. And it's a pessimistic take, but it's a realistic one, because look at the net effect of social media, look at the net effect of smartphones. I mean, we can sit here and debate about the good side and the bad side, but it's clear that every technological change has brought with it often more bad stuff than good. You're saying, what do we do then? I think we need to take back control of our lives and try to draw lines and separate good from bad, because the governments are not going to protect us, companies are not going to protect us, and the regulators are not as well. Finally, I with the AI chip story, I think that, because that's specific to NVIDIA, I think NVIDIA is a particularly, I think, actionable company in terms of AI, because it's already in the business. AI chips require special features that NVIDIA has invested in upfront. You remember the investment graph that you saw in R&D and capacity. And the estimates right now is that AI chip business is about $15 billion, that NVIDIA holds a dominant market share. To be quite honest, I don't think the people throwing these numbers are quite sure, but it's a small market right now, and NVIDIA has a dominant market share. It's also believed, and I think that there is consensus on this, that this market is going to get much bigger over time, and that NVIDIA is going to continue to be a dominant player. Now, we can debate how big that market is, and I checked around for estimates, and I saw estimates ranging from $200 billion in 2030 for the total market for AI chips, to 300, 350, even 400 billion at the upper end of the spectrum. So I think I'm ready to do the lead-in, and let's talk about how to value NVIDIA with what we've learned about the AI story. What does AI add to NVIDIA value? I think the driver for NVIDIA's success has been its capacity to turn out high-performance GPU cards, and that other companies are still scrambling to catch up. So the fact that NVIDIA is positioned so well in the AI market after its success in gaming crypto reinforces what I said before. This is not a lucky company. It's a company that's designed to do this over and over again. Okay? So I think as we look forward, I think NVIDIA will continue to dominate the AI business. And it's also got its foot into the automobile business. Much smaller footprint right now, but I think it's well positioned to take not a dominant chunk, but a sizable chunk of the automobile chip business. So that's going to be my story. A company that's going to continue to go for growth, often in niches which are profitable, and continue to deliver high margins. So let me break the story down. My revenue growth story for NVIDIA, my story for NVIDIA is that it'll continue to be a high growth company for the next decade. That's kind of tough to do given how much it's grown over the last decade. I think some of that is going to come from being in existing businesses like gaming, which are continuing to grow, albeit at a lower rate. But also the bulk of the growth for NVIDIA is going to come from the AI chip business and the auto chip business. So you can see my projections for the two businesses. I expect the AI business to grow from 15 billion in total market terms to 325 billion. The auto business to go from 20 billion to 200 billion. And I expect NVIDIA's market share to slacken in the AI business from the dominant 75% to a still dominant 60%, because everybody else is coming after this business. And the auto business, I think that their share, which right now is tiny, about 3%, will rise to about 15%. Why? Because that business has a lot more competition, and some of it is going to be auto companies taking in-house the chip production. The gaming and other businesses, I think you're going to see revenue growth at 15%. The only reason it's that high is there are other new businesses that will keep coming in and adding to the growth. But that growth rate is going to start declining after year 5. So based on my revenue story, I'm projecting NVIDIA's revenues to increase from about 26 billion to about 266 billion. This isn't a pessimistic story. This is a very upbeat story, a tenfold increase in revenues for a company that's already been successful for a decade. Now, what will happen to margins? I do think that the company will continue to inch up in margins and deliver premium margins relative to the sector. If you remember, their margins were about 38% between 2021 and 2023 for an R&D adjusted value, well above the industry average, which was closer to 26%. I think that premium will continue and in fact edge up. My target margin for the company is 40%, but and that may look high given where the industry is, and it requires a bounce back from 2022, which was in fact a down year, but I think they will make it. In terms of investment efficiency, if you remember, they've been investing a lot. They were getting only about 65 cents for every dollar invested in 2022. I do think that they will be able to get more bang for their buck going forward for two reasons. One is, some of the investment they need for future growth, they've already made. The bulk of the investment for the AI growth, they might have already made with R&D. So I will push up the revenues they can get per dollar capital invested to about $1.15, which is the industry average. Finally, on risk, I did estimate NVIDIA's company-specific cost of capital at 13.13%. Now, the decimals, I know a little bit of an overkill, but the industry average is 12.21%. And going forward, I'm going to stay with the industry average because the company has changed so much over the last few years that using that their company-specific cost of capital might actually be biased against the company. If you feel strongly about keeping the 13.13%, go ahead. Over time, though, I will assume that the cost of capital will drift down as chips become used in everything. I think that the cycles in the chip business are going to level off as chips become a component in almost everything we use, from appliances to automobiles. So with that story in place, let's see how the NVIDIA valuation plays out. So here are my projections for NVIDIA. I know there are lots of numbers on this page. It's easy to get distracted, but focus on the story parts. You can see my growth story for revenue growth broken down into three businesses: AI, auto, and gaming and other businesses. My profitability story for margins and my growth efficiency story that play out in the operating margins, the sales to capital ratio, where I've assumed the effect is the same across the three businesses. The risk story that captures change in the cost of capital from an industry average down to market-wide average. And the fact that they have competitive advantages that leads me to give them much higher returns on capital than the typical company or even their own cost of capital. You discount the cash flows back. I've broken the value down to three pieces: the value of AI, the value of auto, the value of gaming, and the rest. And you can see that the bulk of NVIDIA's value that I get is coming from the automobile business, from the AI business. So you add them up, I come up with the value of the operating assets of about $583 billion. Not much debt, no minority interest, cash of $15 billion. You get a value of equity per share of about about $240 per share. Now, and that's what I think is a pretty upbeat story of revenues increasing tenfold over the next decade. Margins, which are already at premium levels, continuing to go up at least by a little bit, and a reinvestment that is more at the industry average level than the company's own. Okay. The bottom line is the stock was trading at $409 on June 12th or June 10th when I did this valuation, June 10th of 2023. And we'll come back and talk about what to do next. But it's quite clear there are a bunch of assumptions driving my valuation, and I would expect you to disagree with my assumptions. So to capture that disagreement and the uncertainty I feel about the future, I did what I've typically done in other discounted cash flow valuations. I set up a Monte Carlo simulation, but rather than use a single number, I allow my estimates to become distributions. So for revenues, for instance, I brought in uncertainty about the total market for AI, where they're ranging from $225 billion to $425 billion. NVIDIA's market share, where I assume 60%, could be higher, could be lower, depending on the upbeat or a downbeat story. The total market for auto chips, $200 billion, could be anywhere from $100 to $300 billion, depending on how much automated driving takes off. NVIDIA's market share, 15%, it's very possible that they could have a bigger market share or a smaller one. And the same thing with the growth in the gaming business, the compounded annual growth rate. The bottom line is my revenues, which are $266 billion, could be, in year 10, could be much higher or much lower. For the margin, it is true that I built around a base case of 40%, but it's entirely possible the margins could drop back closer towards the industry average of 30% or climb because NVIDIA finds some new and productive way to run its business to 50%. For the reinvestment, my base case was that NVIDIA would move to the industry average of 1.15. But again, there's much uncertainty. It's entirely possible that they could slide back towards the lower sales to capital ratio there in the last decade, or the last 2 years, 0.65, or they could slide up towards the 75th percentile of the industry, which is 1.94. And finally, on the cost of capital, I did use a 12.21% cost of capital, but who knows, right? Things could change. Semiconductor business could become safer, at least in the eyes of the market, or riskier. So I brought an uncertainty to all of my key inputs. And in this picture, I've captured the effect of bringing in those distributions. So you see my distributions for cost of capital, margin, and sales of capital on top of my revenue uncertainties. And you let them play out. And I ran 100,000 simulations. You can see that my distribution of values reflects my uncertainties. My median estimate is about $236, very close to my DCF, but that should be no surprise because I built my distributions around my base case estimates. The 10th percentile is $166, which actually the stock hit, if you think about it, not that long ago. And at the 90th percentile, I have $326. You're saying, where does $410, which is roughly where the stock was trading at, fall? If you ask me, is it possible that NVIDIA is worth $410, the June 12th price, I would say yes, it is possible. But then I'd add, it's not plausible because it's the 95th percentile, at least based on my distribution. Put differently, at a $410 price, at least from an intrinsic value standpoint with my inputs, it looks like there's only a very small chance, 5% chance, the stock could be undervalued, and a 95% chance it's overvalued. Another way of seeing what needs to happen to justify the price is to take what I think are my two big inputs, what I think will happen to revenues and what I think will happen to operating margins. If you remember, in my base case, my revenues were about $266 billion. Maybe I've undershot. Maybe they're going to be closer to $500 billion, which would make NVIDIA one of the largest semiconductor chip companies make it by far the largest semiconductor chip company in the world. Or maybe I'm overestimating. Maybe it'll be closer to $100 billion. After all, their revenues right now are only $26 billion. Even $100 billion would be a fourfold increase. My margins in my base case, I use 40%, but as I said, that number could be lower or higher. So what I have in this table is my value per share that I get for NVIDIA with different combinations. Seeing what are the shaded numbers? They're the values that are greater than $410 per share. They tell you what needs to happen to get to $410 per share. Put simply, to justify paying $410 per share, you'd need revenues of at least $400 billion in 10 years and a 50% margin. Or if you can get to $500 billion revenues, then you can get away with a 40% margin. I'll be quite honest, I think getting margins above 40% is going to be really difficult in this business simply because the gross margins are the gross margins. It's not a software company. You can't push the margins up to 60 or 70%. If there's upside here, it's got to come from revenues kind of overshooting. And that, I think, is a more plausible story, that NVIDIA finds two more new business that we don't even, think of how quickly AI came onto the radar. Two other businesses like that, $200, $300 billion markets, NVIDIA could get there. So there is a plausible path, but it's a narrow one. So what are my takeaways? Basically the takeaway is, the market pricing right now requires a combination of extraordinary growth and supernormal margins. Whether you use the simulation or the break-even analysis, that's what you would need. And I think if there's going to be upside, it's less likely from the margins kind of shooting through your estimates and more likely to come from revenues growing faster than you expected. So now it's time for Judgment Day. I told you that at the start of this session that I owned NVIDIA. I bought it in 2018. I'm glad I bought it. Of course I am glad. It's done really well. And when a stock does really well, it's tough to let go. You want to hold on to it. So I'd be lying if I said this is going to be an easy decision. But I've also kind of made clear that I'm a value investor. And to me, the definition of a value investor is not the Ben Graham definition or even the Warren Buffett definition. It's I believe in buying stocks when the price is less than value. That's why I bought NVIDIA in 2018. And if I'm consistent then, and I believe in value, and I just told you my value is $240 per share and the stock is trading at 410, then I should sell, right? I've never believed that you can be consistent only one side of your investment transaction and not the other. But at the same time, I don't want to let go. I mean, that's, honestly, I want to hold on for the optionality. What do I mean? I do think, as I noted, there's a plausible path, and given how well NVIDIA has managed to be in each of these growth markets ahead of the rest, I can't put it past them. So I split the difference. I know it's weaseling out of the choice, but I split the difference. I sold half of my position because I think the stock is overvalued. I held on to the other half, not as a value investment, but more as an option. That this is a stock that could continue to surprise me with its optionality. I know that there are purists who will take issue with me for not selling my entire position, but I'm not a purist. I'm a pragmatist. No. And in this case, I am cashing in on a significant profit in my original investment and holding on to the rest. Now, of course, I'm speaking as an investor. There's a very different perspective you can bring to the game if you're trading NVIDIA. I mean, you're saying, what's the difference? Investors value companies, they buy if the price is less than value, and you sell when the price is higher than value. They often have long time horizons, and the key skill sets you need to succeed as an investor is being able to estimate value and being able to find price catalysts that will cause the price to adjust to value. I used a discounted cash flow model. Let's face it, most people who are buying and selling NVIDIA now are trading. What is the difference in trading? In trading, you really don't care about value. You buy at a low price, you sell at a high price. You're saying, what causes the price to go up? Your reaction is, I don't care. It could be because of good reasons or bad reasons. Either way, you make money. And to trade, your skill set is you need to be able to gauge mood and momentum, because that's what drives prices. And people have become rich trading mood and momentum. And momentum is an incredibly strong force in markets. And right now, the force is with NVIDIA, obviously. Look at how much the stock has gone up. So you're going to be riding momentum, and it can be a good ride as long as you get off at the right time. Because momentum gives, but it also takes away. It'll shift. The key skill set that traders need is being able to detect those shifts in momentum. And there will be one. It's not a question of whether. Take a look at the price graph for NVIDIA, the ups and downs. There will be another down. So if you've never owned NVIDIA and you're beating yourself up, stop. There will be another drop in the price where you can get in. And if you're a trader, remember that you need to detect those shifts in mood and momentum. So if you're using charts to do this, all the more power to you. And don't let the value scores take away your happiness if you in fact traded NVIDIA and you made a ton of money. Congratulations, well done. Now, as a follow through, basically, as I so to sum up, then, if you're a trader, it's all about momentum. And my only pushback is for those people who say, look, momentum can drive a stock forever, that the stock can keep going up and nothing will stop it because there are enough people buying. That never holds up. There will be momentum shifts, and you will have to get out before that momentum shift. So, what's my bottom line in AI? I mean, I believe AI is more closer to revolutionary change than incremental change. It'll change the way we live and work. But I don't necessarily believe that investing in AI-related companies is going to generate high returns for me, right? You can get the macro story right and be awfully wrong on the micro story. There's many a slip between the cup and the lip, because history tells us, especially with revolutionary change, that while there are winners in the business, there are lots of losers, lots of false starts, lots of wannabes. And you're going to see a lot of those false starts and wannabes in the AI business as well. I know there are some people who are stepping away from the AI space or refusing to deal with it by saying there's too much uncertainty. We can't make judgments on what AI will do for companies. Okay, that's fine, as long as you then stay away from any company where AI is affecting its price. But think of how much of the market you're going to be stepping away from. I've never believed in hiding from uncertainty. Make your best estimates. You're going to be wrong, but so what? So is everybody else. As a society, though, I no, I'm not sure where AI is going to take us. And my pessimistic take is every time we have revolutionary change, especially when it's technology driven, we're told about all the good stuff. Then we wake up to a lot of bad stuff. And I am afraid that AI is going to bring its share of bad stuff. I'm not going to complain about it and write posts about the terrible things. That's not my vibe. But I have to devise my own mechanisms for protecting me and my loved ones from those AI related consequences when they do happen. When, it's not a question of if. And I did think about an experiment, asking ChatGPT to write this post for me. I wanted to see how good AI already is. And ChatGPT can go back and look at every one of my past posts and every one of my past valuations. One of these days I'll show you what ChatGPT wrote as my NVIDIA AI post. But I don't think it's ready for prime time yet. Not yet. Doesn't mean it won't be ready in 2 years or 5 years, but not yet. And thank God for that. Okay. So I wish you the best. Take care. And thank you for listening.